Hello and welcome to BQ Prime. Figures for CPI inflation and industrial production were published a few moments ago. While retail inflation saw an uptick in June, after having eased to a 25-month low last month, IIP growth surprised on the upside, coming in at a 3-month high as well. Retail inflation stood at 4.81% in June compared to 4.3% in May, and this was higher than was expected. The rise was largely because of a rise in food prices and is expected to persist in the ongoing month. To share more of her commentary, we're joined by Yuvika Singhal from Quantico Research. Yuvika, thank you so much for taking time out. To begin with, what's your early takeaway from both figures?
Thank you, Pallavi, for having me. First take, I think definitely CPI has come in as a good shock. So definitely above our expectation, pegged close to about 440, and even market expectations, which was slightly above us. At 480, there's definitely an upward surprise that has come in. Large part of it, as we were suspecting, to be driven by food, and within food, tomatoes in particular, which have seen prices skyrocket, along with some price pressures that we are seeing within wheat and pulses also getting reflected in the June CPI numbers. IIP, on the other hand, like you rightly said, again, an upward surprise, but a positive surprise there. So the momentum is holding up, it appears, well into Q1 of FY24 as far as economic activity and manufacturing activity is concerned. So while definitely a negative surprise on CPI, a positive surprise on IIP, balancing out the two data prints that we have just seen.
Right. So to be sure, the rise in inflation is largely led by food items. Core inflation has more or less remained constant.
That's right, Pallavi. Though we do see core inflation, which is measured as RBI core, rise marginally, but it continues to remain largely comfortable, if I could say so, from slightly above 5%. That was for the month of May. June number is close to about 5.1. So not a lot of difference. A large part, like I said, of the uptick that we are seeing, and especially the surprise that we are seeing in the CPI number against our expectations, has been driven by a larger than expected spike getting reflected within vegetables, which carries a weight of almost 6% in the CPI basket. Along with it, wheat, which was in a deceleration mode over the last 3 months. So month over month, we were seeing prices correct. That has taken a turn. So the tide has turned as far as wheat prices is concerned. And if you will remember, this was the month when we saw an excessive heat wave. There was procurement that was happening, which was slower than expected. Also, the buffer stocks of wheat have continued to dwindle. And all these factors did reflect on market prices of wheat. So this was also somewhat baked in, along with the price increase in pulses, and especially within which tool prices, which is one particular type of pulse, which have also been on an escalating trend. So all these three, along with some price pressures coming in from other items such as eggs or spices, all these items put together have ensured that the month-on-month momentum in food is extremely high, above comfort level as far as the momentum is concerned for the month of June. Just to put this in perspective, so typically in the month of June, we do see price pressures building in, especially for vegetables. It's typically onset of, the impact of onset of summer seasonality that kicks in, and the impact of which is felt in June. To put this in a quantitative terms, typically over the months of June and July, if you go back and look at 9-year average increase in the price of tomatoes, we do see that close to 70% increase in price of tomatoes takes place in the months of June and July put together every year. So the spike per se in tomato prices is not unnatural, but it's the extent of uptick that we have seen, almost close to about 200% now, vis-a-vis end of May, that has actually been on a much higher side, which is probably likely to have impinged on not just June vegetable and thereby the headline CPI inflation, but also is likely to have an impact on the July numbers, which will be announced in August.
All right. So that was actually going to be my next question. Even considering high frequency prices, the momentum seems to have sustained well into July as well. And we can expect an even higher figure in July for retail inflation. Would that be correct?
Yes, it seems so. Early days yet, because we have not even crossed the halfway mark as far as this month is concerned. But initial data up to, say, yesterday, we have high frequency daily mandi prices. And if you look at this daily data, we do find that the momentum in the escalation of tomato prices has in fact more than doubled vis-a-vis the momentum that we saw in the month of June. So clearly the momentum is not just increasing, but it's increasing at a very fast pace. So put this in perspective, the month-on-month rise in tomato prices in the month of June was close to about 70%. In the month of July so far, which is just 11 to 12 days of data, the increase is almost about 150% month-on-month. So a very steep increase that is happening. Our own estimates suggest that if tomato prices were to retain at current levels for the rest of the month of July, we could see incremental price pressures to the tune of maybe 50 to 60 basis points on the headline inflation, that is for the July print, that is. So again, we are assuming that prices are not correcting in a quick hurry, largely because there has been a multitude of factors that have been at play for spiking the tomato prices this year. It's not just the summer seasonality and the hot onset of summer, which has had an impact on prices, but along with it, the pest attacks that we saw in some of the states, also the erratic monsoons that we saw, that is before the onset of the southwest monsoon season. So if you remember, Feb saw extremely hot temperatures and followed by March, which saw a lot of downpour in some of the states. So all these inclement weather has had a role to play on lowering the production. And it will not be another few months before the Kharif output of tomatoes hits the market, when the tide could actually turn. So if the prices were to remain where they are in the month of July, yes, the July print is likely to look even higher vis-a-vis the June number that we have seen.
Okay, so you mentioned the Kharif sowing patterns. So far, while the monsoons have caught up, there's still a little bit of a lag in terms of sowing, and that coupled with current price trends, what's it looking like to you?
So Pallavi, I think there are two factors at play here. So one, while we do see that there has been a shift in the monsoon at the all India level, where we were somewhere in a deep deficit around 10% as of end June. Now we are sitting in a surplus of about 2%. But if you look at the distribution of this, it's been extremely uneven, with the northwestern part of the country receiving excess monsoon. In fact, a lot of states in the northern part of the country, including Haryana, Punjab, have received a large amount of torrential rain downpour in the last week, which has skewed the headline number to some extent. And if you look at some of the southern states, they are still reeling under deficit. Central is in a minor surplus of 4%. So there is a large uneven distribution of rainfall, A. Second, an excess amount of downpour that we have seen in the northern states could have a deleterious impact on the sowing, because there is a deluge of water that needs to be taken care of before the sowing could actually take place, or if the sowing had taken place, that could actually be detrimental to it. So keeping all these factors in mind, if we look at the Kharif sowing so far, it continues to lag last year's level by close to about 5.5%. So sowing is yet to pick up materially, even reach last year's level. Again, I think we will have to wait for monsoon to pick up and the spatial distribution to improve for the sowing to catch up in a more material way. Having said so, this is largely, when we talk of sowing, we largely focus on typically the cereals and pulses and core cereals. But we forget that vegetables and horticulture oriented products have a much shorter sowing turnaround. So these are typically cropping cycles which last for a few weeks to probably a few 2 to 3 months. They're much shorter in their turnaround time. And that is where we expect that the spike that we have seen in vegetable prices could be much sharper in its correction as well. So when we actually do see the Kharif output of tomatoes hitting the market somewhere around August and early September, the turnaround in the seasonal spike that we are seeing in the months of June and July could also be as sharp, but probably backloaded towards the months of September and October, when the harvest actually hits the market. So we'll have to wait and see whether this spike that we are witnessing is truly temporary, as we are expecting it to be, or how much of it is actually going to linger on. But we do find that there are these seasonal factors which remain at play as far as CPI is concerned. So we do expect the Q2 CPI inflation number to probably print higher than RBI's own expectations, and probably the reversal of it could happen somewhere in Q3.
All right. So better than expected IIP figures indicating that growth still remains fairly resilient in the Indian economy. However, higher than expected in inflation figures as well. What does this mean for the Monetary Policy Committee as it goes into its next meet?
I think it's a very clear takeaway for the monetary policy that the prolonged pause that we are calling for, and we have maintained that stance since the last policy meeting. And I remember discussing this with you a month ago when the inflation number was released, that the May print that we saw is likely to be a local minima, a trough in this current phase of inflation, and the subsequent readings were expected to move up, though there has been an upward surprise there. Nevertheless, the trajectory of inflation has turned, so we are past the trough, and subsequent readings could be in the vicinity of 5.5. So for the year as a whole, we are still holding on to our inflation forecast of 5.3%. We do feel that there are risks attached as far as vegetable prices that we are seeing, or as far as the impact of El Nino, which is still to unfold completely. So there are risks on the upside, while I would also attach that the comfort on global crude oil prices and the possibility of cutting retail fuel prices on petrol and diesel sometime, in the visible or the near future could probably impart some downside to our headline number. But there are too many moving parts at this point in time, and we believe that we are comfortable holding on to the 5.3 inflation estimate as of now. And what this means is that inflation, while is correcting and is on a glide path lower, RBI is probably not seeing inflation get into its 4%, that is the mid point of its target range, sometime in the foreseeable future, at least not in this fiscal year. And what this means is that the timeline for rate cuts would probably happen only in the next fiscal year, that is FY25. So a prolonged pause for FY24 and the possibility of rate cuts, given that inflation follows the downward trajectory path that we are outlining. There is a seasonal correction that ensues after Q2 with the harvest of tomatoes and other Kharif products or Kharif products coming on board on the market. And probably that if plays out in line with the expectations as far as the inflation timeline is concerned, we are probably looking at rate cuts early in the next fiscal year, not any time before that.
All right. Yuvika, thank you so much for taking time out. Stay tuned to BQ Prime for continuing updates on the economy.
How do you make the most of the India opportunity as an investor? For that answer, all roads lead to BKC in Mumbai on the 13th of July. 3 big money managers describe the size of this opportunity. 2 of the largest mutual fund CIOs then tell you about the mega trends that they're investing in. Will the current capex cycle be similar to the one between 2003 and 2008? We get that answer from Sanjeev Sharma of ABB in a conversation with veteran investor Madhusudan Kela. And then we rounded off with 2 of the most prominent investing names talking about how to make the large bets and make it really big. All of this and more at the Trident Hotel in BKC on the 13th of July. Catch the action live on BQ Prime.